Time is as precious as gold, so we need to kick off with Imaru Casanova. Welcome, Imaru, to our Benzinga virtual event.
Thank you so much, Piero. Thank you for having me.
I'm excited to have you here today. I'm going to ask you a couple of questions for the next 15 minutes. Maybe we can start with a consideration, regarding the gold mining industry. Gold prices are 16% higher compared to a year ago, and the Federal Reserve is likely going to deliver the last rate hike next week, according to what market participants are expecting. Is this a perfect setup for the gold mining industry? Are there all the positive catalysts in place to see a new super cycle for gold mining stocks? We'd love to hear your thoughts, Ima. Thank you.
Yeah. Let me start by saying that, yes, I work at VanEck, and VanEck is the manager of both the GDX and GDXJ gold mining ETFs. To be clear, I'm the portfolio manager for VanEck's gold mining active strategies. So I just wanted to make sure that's clear, particularly International Investors Gold Fund. So yes, I do think, Piero, that the end of the tightening cycle could be a potential catalyst for gold, and a strong catalyst for gold. Ever since the hiking cycle began last year, as we talked to investors, the concern was always, gold. We're not interested to talk about gold while the Fed has just embarked in one of the most aggressive tightening cycles ever. And so a skip, even if we have a couple more hikes here, certainly the end of the cycle seems to be in sight. And we do think that will could provide a catalyst for gold. Gold has, like you said, it is sort of a perfect setup. We still think there are globally there is a lot of support for gold in this environment, and the miners are very well positioned to really demonstrate their leverage if we get gold prices higher from here.
Thank you, Ima. Maybe there is a little bit of noise from your mic. I don't know if you can try to fix it up.
I don't hear anything here.
Okay.
And I'm using an iPad. Sorry about that.
Maybe can you try with headphones? Or
right. Are we allowed to do that now?
Yeah. Of course.
Let me see.
Because I hear noise.
All right. Let me see if we can. I brought my headphones down. Do you mind if I step away to get my headphones?
No, as you want. Or maybe we can keep going. No worries. It's not a big issue.
Okay, usually it works okay. All right. Do you want to try again then?
Okay, it's okay. Let's move on with the second questions. Why, in your opinion, are gold mining stocks trading at a relatively cheap valuations, both compared to the price of gold and from a historical perspective? And can you give us some idea on the median PE ratio in the gold miners ETF GDX fund? Thank you.
Yeah, no, you're very right to point out, and that's one of the strongest arguments for investing in gold mining stocks today is that, one, they are historically trading at very low multiples. And, whatever multiple you look at, price to NAV is what we like, but cash flow, price to earnings are levels that are historically very low for the sector, And this comes at a time where companies, the gold mining sector as a whole, is in really good shape as far as balance sheets, costs coming under control, companies exercising good capital allocation. So the multiples really are, in our view, not justified, and a re-rating is something that we see in the future. You also bring up the point that not only are they cheap and trading at low multiples historically for the sector, but they're also relatively to gold trading at a pretty big discount. And the stocks have been lagging gold for a couple of years now. And so I think we talked about this. If you looked at where, stocks were last time gold was at these levels, and today we're somewhere around 1970 again, after a bit of a bounce back this week. The stocks were, at least if you look at GDX, GDXJ, 15 to 20% higher than we are today. So this makes a very compelling case for the gold mining stocks. We always tell investors the following. One, if you don't have a gold allocation, if your portfolio has zero exposure, that makes no sense to us. We always get asked, when is a good time? And the answer is, if your allocation is zero, it's always a good time to consider an allocation to gold. Secondly, we always get asked, well, okay, so if I've decided I'm going to invest in the gold sector, do I invest in bullion? Do I invest in gold stocks? And the answer is probably a mix. Very much depends on your risk profile. The important thing to remember about gold stocks, the most important thing to remember about gold stocks when you're considering a gold allocation is their leverage to the gold price. So a 1% move in the gold price could result in 2-3% moves in these stocks, both ways, right? It works on the way up, it goes on the way down. But today, if you're asking yourself, how do I allocate bullion, gold stocks? If your risk profile allows, the gold stocks are positioned to, like I said before, enjoy a re-rating. And because they are trading at such low multiples, they're looking very attractive to add exposure to gold.
That's very interesting, Ima. Thank you for that insight. Related to the last part of your answer, I wonder if you can tell us which are the stocks with the highest or lowest correlation or beta compared to the price of gold. That could be interesting.
Yeah, so I probably won't, out of the top of my head, know all the names, but here's what you need to know. It's simple.
Okay.
And when you look at a company, they report their costs. They will, we're getting reports. Actually, Newmont kicked off the earnings season today with the Q2 results. But when you look at a gold company's statements or even summaries or fact sheets, you'll find a production figure, annual usually, and you'll find an all-in sustaining cost. The acronym is AISC. It stands for all-in sustaining cost, and it's a metric that is supposed to capture most of the costs, including capital costs, that go into sustaining that level of production. And so when you look at that figure, if you want to know how levered to the gold price as any stock is, I don't need to tell you which ones. Just look, if the higher the all-in sustaining cost, the greater usually the leverage to the gold price. And that comes from the fact that a small change in the gold price can translate into significant margin expansion for these higher cost companies.
Wow, super interesting, really. So you mentioned Newmont that kicked off the earnings season for gold miners today, and they missed earnings expectation. Can you share us some insights on the upcoming earnings for the other miners? How do you see the results going forward for the industry? And then if you can wrap up, providing us with 3 top stock recommendations for the upcoming months.
Sure. Yes, Newmont reported results that were below expectations. We were expecting some weakness in the results, given that they did have a strike at one of their main mines in Mexico, at Peñasquito, a labor strike that caused them to cease production there temporarily. That was sort of built in, as well as some wildfire issues in Canada impacting another operation, but there are a couple of surprises there that brought production further down. The stock it's weak today on those results. The market is very much focused on companies meeting expectations. So it is critically important that companies meet operational and financial results for this gold mining sector to really achieve that re-rating that we've been talking about. Overall, we think this year, we already had reports. We started to get preliminary reports from Q2, and obviously today, full report from Newmont. We see this year as a much better year on the reporting side for these companies. Last year was a tough year, mostly because the companies issued their cost guidance well before the war broke out. And obviously with all the issues and the inflation that developed after that, most companies basically had to reissue guidance, and they missed expectations. And like I said, the market punished them for that. This year, what we've seen companies so far in line or beating expectations during Q1, Q2, it's probably going to be similar to Q1. Costs do seem to be under control this time around. If anything, we see companies maybe having built a little bit of conservatism in their price and their cost forecast to make sure they don't disappoint. But also one thing that the investors should remember is that sort of for the whole industry, the second half of the year is guided by the companies to be a much stronger half. If you look at most of the larger miners, they're saying Q1, Q2 is not going to be as strong as Q3 and Q4. So we look for the second half of the year for companies to catch up. In fact, Newmont, like I said, had below market expectations, below market estimates results today, but they maintain their 2023 guidance, which means they expect to make up the difference in the second half of the year. So a much more constructive, we expect, year for the gold miners in 2023.
Okay, Ima, we have the last minute. So 3 stock
recommendations. The top three.
And then one very last question. In 6 months from now, where do you see gold prices?
That's always the most popular question. So first, the top picks. I'll say 3 names that I really like, 3 companies that we like. One, Endeavour Mining, ticker EDV, in Canada and London. They trade, and it's a stock that came from being a small to mid-tier producer to now becoming a large producer with over 1 million ounces, all done through very well thought out acquisitions and developing projects, also organically, dedicated to increasing reserves organically at all of their mines and putting some ambitious targets out there. West Africa focus, really great delivery, great team. We really like that name. Is in our active fund, one of our top holdings. We also like Alamos Gold. Alamos is a miner again that started with 1 little mine in Mexico and today has 3 mines and is embarked in a again ambitious growth project at one of its mines in Canada and the Island Mine, and they've been doing that in a very disciplined way. We see the costs at Island are going to be, you know, we talk for all-in sustaining costs for the sector on average around $1,300. I think the Island Mine is expected to have costs of around less than $900 per ounce. So a lot of free cash flow growth coming for that company. And then Agnico Eagle. It's a high quality name, has been historically, continues to be. So we also like Agnico Eagle. And then on your question regarding price forecast for gold, that's always the question we get asked. I personally don't love issuing targets, but everybody wants to know a number. We've put out, and if you look in our publications, we put out a monthly with our thoughts and views on the gold sector, which I recommend investors look at. It's public and it's a really good way to keep up with what's happening in the sector. We put out a 2075 gold price target for the near 12 months or so. That's the all-time high. We think the all-time high is well within reach. Obviously, we've made a few attempts to cross that, and those have failed. And that's why I like to set that as our next target. Let's cross the all-time high, and then the potential could be much larger from there.
Thank you so much, Ima, for sharing your invaluable views and your deep expertise about the gold mining sector. It's been really an amazing opportunity to have you today. We are grateful for your time, and we hope to host you again for our future Benzinga events.
Thank you so much, Piero. I appreciate you having me. Thank you.